Good afternoon, expats. My name is Jeremy Harper. In the hot seat, I've got James Ridley on the line. We are bringing you another episode today. Today, we want to talk a little bit about sort of the end of financial year, some things that dropped out in the market that we want to get across, a few New South Wales budget changes and a few questions. So before we get into that, throw it over to James. How you going, James?
Yeah, good morning, mate. I'm well. We just wrapped up a bit of a tax webinar for those coming back from the United States, which is well some great attendance on that one. As we enter into a new financial year, we often find now is a good time to hit the reset button and start
Hmm.
planning for the next 12 months. Taking notes from obviously the recent budget changes which have swept through and are now probably receiving royal assent very, very soon as part of being obviously uh, legislated going forward now. So being mindful around that. We are still waiting on the draft legislation with tranche two, which is all the trust changes that they want to make. But
Yep.
now, whenever you're looking to invest in property, obviously taking that into account, the changes and what that might mean around your strategy. I think structuring is going to be such an important one going forward whenever you're investing back in residential property in Australia. So yeah, some really important ones there. We've got some great segments today as part of that financial year wrap up. Obviously how the market has performed on the 12 months, totality, putting out some great data there. So we'll unpack that a little bit.
Yep.
Where to for the next update from the RBA, obviously, and whether we're going to get a rate increase, cut or hold. I guess talking about some tax changes, I feel like now that we've been through the federal budget, we often forget that there's state budgets that come out. I think when we had the Queensland budget only a couple of weeks ago, it was a bit of a non-event. I didn't even
Mm.
realise that it happened. So there's been some important changes there, especially out of the New South Wales one. And then we've got some great Q&A that we'll unpack as well for the last part of today's session.
Fantastic. So let's jump into it. So we've had the totalities release the June numbers. They've
Yep.
just come in quite fresh. And I
Yep.
guess focusing on the big market, Sydney, what have we seen there?
Yeah, it's not good. It's reversing at the moment. It's not a surprise. I think when we look at the month on month negative 1.2% for the month of June, quarterly similar when you stack it out 3 months, about 3.2% down. Annually, it is just up by 0.3%. So
Yep.
it's really sidesteps for the year. A lot of that's obviously been caused by interest rates going up, less investor demand, and then I'd say a lot of investor demand probably came out of the market very quickly after the budget. So that's only a short period though. Remember that's, month and a half.
Mm.
So that market and it being stagnant and stale, that would have really started last year for the first 6 months. So it means that we might see that theme continue until there's signs of life where interest rates start to come back down, money gets a bit easier and cheaper to access. What was your thoughts on some of the other majors?
Yeah, well, I mean, on Sydney, this is clear. Sydney's a market where it's relatively easy to kind of track it, and it is very much tied to the RBA. So this is on the back of those three rate increases early this year. I don't think the budget's news has filtered into the Sydney market in this data just yet. What I'm seeing on the ground is as you know, February, March, it turned into, particularly February, turned into a buyer's market in Sydney. And now you're starting to see really there's like, if you look at some of the clearance rates in Sydney, it was 47.3%. And if
Mm.
you look at the 4-week average, so we're not just looking at sort of a weekend in isolation, that slipped to 49%. So that they do say that, look, anything sub 50% clearance rate, it is
Yep.
a buyer's market. And that's the weakest it's been in 6 years. So definitely a buyer's market. People can pick, they've got a fair bit of stock to choose from. Um,
Mm.
the still the A quality type properties where they're presented well are still selling. It's probably similar to some of the commercial market where it's that second tier markets that could have in a hotter market could have still got a really good result. They're
Yeah.
sitting on the market, and now
Yeah.
it's a case of the vendor has to meet the market around expectations.
Yeah, that's right. I think when you look at probably that high end market where you're sort of selling property for over 5 million, that doesn't really change too much when there's interest rates involved because often buyers aren't getting in those properties aren't usually going out and getting a loan. They're potentially mostly cash buyers, to be honest. The market underneath that, that's where we're seeing it sort of slow right down.
Yep.
Remarkably, when we compare it to some of the other capital cities, Brisbane's been firing 17.4% on the annual. Adelaide still going well. Adelaide's been storming along quite well,
Yep.
annualized for a couple of years now. Perth's an interesting one. Perth has just knocked it out of the park for the financial year, 23.9%. Again, Perth is obviously following that mining cycle, so we often see it post some really good numbers depending on the cycle. Darwin is one that surprises me, but I think a lot of investors have flocked to Darwin due to affordability. The
Yep.
median dwelling price there is 638,000. It's the cheapest across the capitals, and that's why it's probably done so well. Investors are just flocking for what's cheap and what they can rent out. So that's obviously where they're flocking to.
Yes. And in terms of rents and yields, so rents are up 5.9% for the year. So
Yep.
strongest it's been since September 2024.
Yep.
Incredibly low vacancies again, sitting at 1.5%. So, a lot of people did say, look, the budget is going to push rents up, and that's what we're seeing. And I think that's
Mm,
going to continue to carry out. So, and that's going to put further pressure on the RBA. I think if you look at the
yeah.
last readout in terms of the CPI, there was a fair bit related to
Yep.
housing.
There is, yeah. We've seen it time and time again. It happened in New Zealand. It's happened in Australia as well when they got rid of negative gearing back in the 80s. Rents actually skyrocketed, and they did grandfather as well. New Zealand, it happened twice, and they just obviously wound it back. So it's, yeah, I mean, a common theme is likely that we'll see rents go up a lot more aggressive compared to inflation. If it goes up too much, let's say it does next 12 months, it does another 5 to 7%, and then it happens again, the government that's in power, whether it's Labor or not, are going to have to fix that and go, okay, we can't really fix that. That's also a state government issue in terms of how much you can increase your rent by. It's not a federal one. So it's like looking to the states to maybe legislate and control and do even rent control like they have over in the United States. But I just don't think that's going to be possible. So it's something that we'll be keeping a very close eye on because this negative gearing might be wound back if rents just skyrocket to unaffordable prices.
Yep. I think that'll get relooked at, or maybe a bit more common sense,
Mm.
limited to a
Yep.
couple of dwellings per person.
Yep.
So over to
Yep.
the RBA, so they've released their June minutes, and anything stick out from your end on this one?
Yeah, I think going into this, we knew it would be a hold.
Yep.
The data that came out from obviously the May, the May CPI data wasn't great, but that's expected. Obviously, we get June quarterly CPI later this month. That's still a couple of weeks away. That's going to be really important for that August decision. I think I think we will maybe see one more rate increase. I just think that June quarter is going to be quite nasty, to be honest. They certainly left the door open in terms of what path they're going to take. But I don't think there was any big surprises based on the minutes, to be honest. What was your
Hmm.
thoughts?
I think from my point of view, it's always interesting to see when they do release the minutes, like what words are mentioned. I think that's always interesting. They talk about growth and prices. They mention those words 22 times. It's quite a
Yep.
small minute. So I think my point of view is that they are looking at the real estate market, and obviously Sydney being the larger market. If that continues on and they see a few more months of that, I think that will do the job of the RBA. That's my personal point of view. So I think we're at the peak. I don't think the RBA is sitting there. I think they know that the inflation is going to be nasty, as you said, in the next 6 months. And I
Yeah.
think they also realize that the real estate market, by that slowing down, particularly in the Sydney and Melbourne markets, the two biggest markets, that will do the job on behalf of the RBA slightly. And I put something up on LinkedIn, over the last 5 years, the RBA always references that 2 to 3% inflation band. I mean, they've only got that right 24% of the time. So it's not a
Mm,
great success. So I think they
no.
are quite flexible on that band. I know they always talk it down and they try and tell the market that, we're leaving the door open for further tightening. But my point of view, I think we're there, and I think they're just going to try and sort of hold this where we're at for as long as possible.
Yep. Yeah, I think you're right. I mean, again, if the data is really poor from the June quarter, I think one more. If not, then I think we'll just see it held where it is maybe throughout the year until things come off. It's hard to believe that the Middle East conflict's still going on. I mean, it just seems like we've had a peace deal almost there.
Mm.
like so many times now, that it's turning into pretty much the Russia-Ukraine campaign in the background, where it's just going to go on in the background. Obviously, the strait will be open, then it'll be closed. They'll be charging, obviously, a toll. They won't be charging a toll. Just think it's going to kick down the road for a lot longer. Interesting though, oil prices have actually come back now. We even see that when we're filling up our cars at the Bowser. It's definitely come
Yep.
back. So not having the same kind of inflationary effect when it first did back in March and April.
Yep.
Changing lanes now to tax changes hitting property. So I think we can probably zoom out first and look at the federal side and then drill down on probably one of the recent budgets out of New South Wales.
Yes. So, I mean, the two big ones is around the capital gains discount being replaced by the indexation with
Mm-hmm.
that 30% floor on any gains,
Yep.
and then the negative gearing. So both of those apply to property held. Well, it's been grandfathered in, but
Mhm.
going forward for new purchases, it relates to people acquiring in their personal name. So we'll touch on that a little bit later, how structure is going to become really important for
Yep.
property investors in terms of what entity. But that's definitely had significant impact on the market straight away as people are just trying to digest how does this actually work and how does it, practically speaking, how's it going to impact people if they're trying to buy and
Yep.
sell property?
Yeah, I think the fear of the unknown is definitely having everyone obviously push pause on buying an investment property and what it means to them. But the CGT change is very punitive, more punitive for actually expats, non-residents of Australia, so Aussies living overseas, which I think we'll jump into very soon around tax structuring.
Yep.
Everyone's going to be paying a minimum of 30% on tax gains now. So previously, the maximum tax you would pay when you factor in the 50% CGT discount if you'd owned the asset for more than 12 months was 23.5%. That's obviously slashing the highest tax rate in half.
Hmm.
So we're all effectively paying an extra 6.5% in tax. And then obviously changing negative gearing, only allowing negative gearing for new builds or off the plans. Everything is still grandfathered, which is good. If you owned it before budget night, that's great. There's that transition period as well. So it will be interesting to see uh, over, say, the next 5 or 10 years, if this legislation holds, whether housing supply is dramatically increased because the investor demand is there for new off the builds to get the
Yep.
tax incentives. I just don't know if it's going to move the needle, to be honest.
No, no, I don't think so at all. There is this big push around, as you just touched on there, this new build and also this build to rent model, which
Mm,
they're defining as sort of a large scale. So if someone's building, say, 50 dwellings, and then they're going to hold on to that and rent that out to the market, sounds great in principle. They've made some changes around that to allow foreign investors. So if they want to invest into that, it's now going to be sort of a 15% tax on that. So they do get a concession on the
mm,
income and on the capital gains. So again,
yep.
that's a huge and accelerated depreciation as well on the back of that 4%. So there's some really big concessions the government's wanting to offer people who are going to bring that sort of build to rent to the market. It's
Yep.
it's been done in other markets. You look at, say, New York, they've got a lot of that. It sounds great in principle. Even the idea of putting aside a portion of, say, that 50 units to make sure that's what they call affordable rentals
Mm,
and pin that into the market. What that
yep.
means is the other residents just end up covering the cost. So
Yeah.
the wash up between the 50 residents in that example, it's the same rental overall. It's just, the people who are not qualifying for the affordable rental are just end up paying a higher rent. So that's going to have further pressure on the
Yep.
housing costs and feedback to the RBA. So yeah, I don't think that's going to work. But also on the back of the New South Wales budget, they also came in and said, we've talked about this previously. There's a 9% foreign purchaser surcharge duty.
Mm,
Now, New South Wales will apply that to anyone buying into New South Wales who is abroad and they're not an Australian citizen. So New South Wales still captures, if you're a permanent resident and you're buying into New South Wales, you'll get stung that 9% foreign
mm,
purchase surcharge. They've
mhm,
now removed that on the latest budget. So from 1 July, they're saying if you are looking to purchase or build a large scale build to rent or retirement living project and you're a foreigner, so that could be, a foreign company or someone that has no connections to New South Wales or Australia, you'll be exempt from that. So a
Yep.
further carve out.
Yep. Yep. It's yeah, I mean, I'm surprised that they're incentivizing foreign investment by removing the purchase surcharge duty because it's sort of is a little bit opposite to what we've captured in the federal budget. But
Mm.
I think I can't see that also doing too much. I mean, we're obviously running a buyer's agency business, which has sort of an end-to-end service where you source the land, find the developer, develop for them. You'd be looking at that and going, this is great for us because, we can now go overseas. We can look at a lot of foreign investment as long as it's getting approved from the third board, those sort of things, and, really project manage quite significant large builds. Again, needs to be 50 new, I guess, residences created through it as a minimum to get access to that eligibility. So, yeah, an interesting one for New South Wales. I wonder if it's come off the back of a slow market in Sydney the last 12 months. Yep.
Yeah.
Good one there. Segment 4, let's have a look here. New financial year, part 4, what expats should do with their mortgage now. So
Hmm.
a fresh financial year, as I said at the beginning of today's session and episode, it's always a good time to reset.
Yep.
Got another 12 months on the horizon. We've got new legislation to unpack and work with, but it's a terrific time to reset, run through your finances, reassess your cash. So what's the focus for the next 12 months?
Yep. Yeah. I think, obviously, checking your interest rate, that makes sense. But particularly around that, if you've got property in Sydney or Melbourne and you want to try and see what your equity position is and your interest rate, making sure you get an evaluation done with the bank.
Yep.
It's something your broker can organize or multiple to see, okay, number one, what equity can I access today? Because if you've got a property in Sydney and the market's going to be materially different in 12 months' time, you want to try and capture that and take advantage of that. So I'd be looking at what's your equity position and then can you get some out, pop in an offset account whilst you're waiting for that next step. That's what we're seeing a lot of. Or just also looking at interest rate, get a valuation done. Has your LVR dropped? Does that trigger us to be able to negotiate harder to get a better deal for you? Maybe with the same bank, but reflecting and updating maybe the current interest rate you're on. So they're the two things I would think about when you're looking at your current loan and your equity position right now.
Yep. And then I think if you are looking to invest this year, next year, taking into account the recent federal government's capital gains tax changes, especially for expats, I think structuring is just going to be such an important one.
Yeah.
One of the nasty surprises which came out of the CGT changes was that if you own a new investment property for any period as a non-resident for Australian tax purposes, and then you come back to Australia and then you sell it as a normal Australian tax resident, throughout that holding period, if you're a non-resident at all, you are not allowed to access that cost-based indexation method. It's written in the legislation. So very punitive. It essentially means that you're paying capital gains tax on the entire gain with no ability to reduce it, except for maybe some cost-based elements. So very punitive. So expats will need to get very strategic around using structures back in Australia. And probably the most common one will be probably a company, setting up a
Yep.
PTY Ltd company. You'll need to have a director that's in Australia, resident director, family member, and yourself can still be directors. You can be shareholders, even if you're non-resident, that's okay. But you will always need a resident director. Getting finance on that could always be tricky because of the way that banks and the lenders look at you.
Yep.
But obviously that's something that Jeremy and his team will look at when it comes to setting up the brokerage. But one of the key I suppose, takeaways if you're using a company structure is that you're capping the maximum tax rate at 30% rather than what would probably be an effective tax rate based on our marginal tax rates, a significant capital gain of up to, say, 42.1%. So you're saving
Yep.
yourself a lot in tax. But again, remember the benefits of companies are that they can retain the profits, so they can pay tax on the CGT event, but they don't have to pay out the money to you yet. They can keep it in there. You can reinvest it into shares and then slowly drip feed it out to yourself as part of, say, a diversified retirement income strategy in the future.
Yeah.
So companies will become quite important. And I reckon unit trusts will also become quite important.
Yeah. So with the expat on that company hat, I was speaking to a number of banks this week and, particularly on the investor side, speaking with the banks, they're very quiet at the moment. So the
Mhm.
new inquiry and so they're getting feedback regarding investors in Australia, not just
Mhm.
expats, but from other brokers as well, saying that is where the flow is going to be. Now, speaking to a number of banks this week about company borrowing for an expat, and some of them are saying, no, we deem that too risky. We're pulling back, or we've changed our policy in the last 6 months. I
Yep.
think this is going to be, it's going to be changing all the time. I've given feedback to say there'll be a lot more business under the company structure. So banks will, I think banks will meet the market on this because they're going to lose all this business if all they're lending to is investors in their personal name. So I think we'll see banks come into this space with updated policy to allow it. Even though a lot of them right now are saying, no, we're not looking at it. You know, banks need to make money. They need to take new business in the door, and that's where the market will be. So if I have a conversation with someone today and go, these are your options, I think in 6 months' time, we'll have more options. That's my read of it.
Yep. Yeah, absolutely. I think a wait and see at the moment. But yeah, I think if lenders are really struggling, I think they'll start to bring on more products, and
Definitely.
obviously ideally loosen some of the restrictions there, which will be good, really good for expats as well.
Like, I'd love to see what the conversations at Save Macquarie are because obviously they pulled out of this the
They
start of the
did.
year.
Yeah, the first ones.
Not anticipating this budget because they do a lot of investor lending as well. So I'm sure they're having some serious conversations right now.
Oh yeah, hope so. Hope so, because that means good things for us and our clients.
Yep.
Okay, we've got some questions that have drip fed through from the online drop form. So let's jump into them. I'll read them out as they are. Kind of actually just address this one, so that's a good one. Question one here. Should an expat buy an investment property in their own name or through a company?
Yep.
So a couple options there. I feel like we kind of unpacked this one a little bit, but yeah, what are your thoughts there, Jeremy?
Yeah, probably just to add on back because we've covered off a lot of this is just more the say you're purchasing a property whilst you're an expat,
Mm,
will you plan to live in that property and
yep.
when? So if it's going to be your place of residence, that's probably a big thing we need to think about, you know. And if that's going to be in 2 years' time, or if that's going to be in 15 years' time, I guess those answers are going to shape the structure as well. Do you
Yeah.
see if someone was to buy in a company and then live in that property, let's say in 5 years' time when they move back to Australia or 10 years' time, or I guess they're just things we need to think about. Is there anything we need to be mindful of there?
Well, it's always hard. Like if it's a property that you're purchasing that could potentially be the main residence, you'd probably prefer to own it in your own name. And
Yeah,
the reason for that is, you'll be able to tap into the main residence exemption for that period that you've lived in it, not for the entire ownership period, but for the period that you lived in it. If you're using a structure like a trust or a company, you won't be able to access the main residence exemption at all. So it's only ever going to be treated as an investment property. The holding costs that you incur for when you live in it, they can increase the cost base for capital gains tax purposes. Um, I will add that it's very rare that we see clients, Aussies returning, buy a property that's going to be a main residence and it ends up sort of ticking every box when they eventually move into it. Often
mm,
we see clients wanting to either offload the property within a 2 to 3 year period because it just hasn't ticked every box.
yeah,
And the suburb that they've bought in, it hasn't gone through maybe the gentrification that they thought, or it's changed a lot, or it's not
yeah,
near the schools that their kids are going to, or the university. So I think often it's usually for an investment purpose. That should be the main goal. Build up your capital, build up your coffers in your offset accounts. And that way, when you come back to Australia, you can take out that cash, use that as the deposit for the main residence, and off you go.
yeah, yeah. I mean, I think we've had a few clients, shared clients where, you know, they've moved back to where they grew up and then they're a little bit older and actually they go, actually, I want something a little bit warmer. So, you know, they don't want to be
Yeah,
in Adelaide or a Melbourne. They want to be a
that's right.
bit further north. So,
Come up to the Gold Coast. It's pretty good
yeah,
up here.
exactly.
Uh, question two here, one for you, Jeremy. Will lenders even lend to an expat buying through a company? Good
Yes,
question.
yeah. So good question. Touched on it before. There's still, you know, I think I was looking at sort of six plus lenders still in this space. They are there's T's and C's on how to qualify, of course. A few more boxes we need to tick. As you mentioned earlier about that resident director, that's just something we need to work through because the
Yep.
banks will want the directors to be giving guarantees on that loan. And
Yep.
then some banks will even say if you've got greater than a 25% shareholder ownership of of that company, they'll also want to wrap that shareholder in as well, which is relatively straightforward. You know,
Yep.
most directors will have the bulk of the shareholder ownership anyway. So, but
Yep.
yeah, so that's just probably the major thing we need to think about.
Yeah, I think we'll probably see clients, Aussie expats using, I'd say, family members.
Yep.
If the shareholdership, or sorry, the shareholders are mainly the expats themselves, it would make sense that the lenders also look at their income. And that's where a lot of the income sourcing, financing, serviceability will be coming from rather than the resident director. But the resident director does get called into the application. So if you're using maybe someone that's retired, maybe your parents as an example, um, but they're also using your income basis, then that might be okay. If you're using like a friend that's, working back in Australia, they've got their own personal debts, car loan, credit card, investment property loans, that's going to really slow down the application. And
Yep.
you've also got to think about from their point of view, your friend or family member, they might not want to have to complete an application. They just thought that they were going to be on there to satisfy the resident directorship and tick a box. So that needs to be given some thought when
Yep.
structuring and setting up that kind of company.
Definitely. Definitely. Because you got to understand your obligations. You know, you're signing on to a loan.
Yeah, yeah, absolutely. So just one of those things to bear in mind, and it needs to be with the right person. So that's a really good question. That person that sent through that question, they're obviously starting to think about tax structuring and trying to navigate the new capital gains tax changes for expats.
Yep.
So I wouldn't be surprised if that's an accountant, to be honest. Um, that's been good. I mean, closing out today's episode, an important one. Prices are down, rents are going up, and they will continue to keep going up. So that does say to us that it's now time for investors to climb into the market. It's definitely getting a lot better and stronger, especially as those yields increase. Remember, everyone's quite nervous now, but often when people are fearful, now's the time to be greedy.
Mm.
So if you can get priced up favorably from a serviceability point of view, there's some great buys there. We've just seen how some of those capital cities have performed. We talked about obviously some of those more mature markets just stagnating, sidestepping. Doesn't mean the prices have dropped, but it might mean in those markets vendor discounts are a little bit more attractive. Um, Darwin's an interesting one. Darwin seems to be doing quite well, but obviously the math there is that it's way more affordable to climb into the market. So definitely consider diversifying into other markets, not just the one that you might live in or that you currently live in. What else as we wind out today's episode?
Yeah, I think that the obviously the sub 50% clearance rates, as we
Mm,
said, with New South Wales going to be having a huge impact. I think they said $8 billion hole in their budget
yep.
due to lower stamp duty and land tax. So
Yep.
I just think that's going to be an interesting story, how the federal and the state government's going to get along with these different changes in the budgets and how it's going to impact different markets. So I
Yep.
don't imagine
Yep.
the New South Wales Treasury will be too happy right now. Uh,
I don't reckon. I don't reckon. So we'll see. See what happens to that. Again, it's the sub 50% clearance rates. Like we haven't seen that for a while. Like you go through different periods where it comes off. Like obviously we're in winter right now, so
yeah,
seasonally it's always a bit lower. But yeah, historically right now it's quite low. Which just goes to show first homeowners and investor sentiment is also quite low.
yep, yep. And then yeah, finally, the note round. We're in the new year, so if you've got an existing property loan, make sure you get your valuations done, review your equity position, review, where your LVR sitting, and can we drive a better deal on that interest rate as well.
Yep. Yeah, absolutely. Really important takeaway. New financial year, new tax rules, start getting that a bit more dialed in, especially if you're coming back to Australia now as well. Remember, these capital gains tax changes, they do not just apply to property. It's all types of investment assets, shares, ETFs. Obviously, it will apply to any sort of investment, industrial property, commercial property. Negative gearing is a bit more dialed into obviously residential, but CGT as a whole is now different.
Yep, yep, yep. Well said.
Absolutely. Well, guys, thanks for tuning in on another episode. And as always, Jeremy, thanks for your time.
Thanks, guys. Thanks, James.